So, an important general concept to understand in the arena of personal finance is understanding whether an asset is an appreciating asset or a depreciating asset. And that's because whether an asset appreciates or depreciates over time will tell you whether it makes sense to put more or less money into it, whether borrowing in order to obtain it makes sense, how much borrowing makes sense. And it really will help you understand your financial picture to know with every asset, is it an asset you would expect to appreciate over time or to depreciate over time? So an appreciating asset quite simply means the value goes up over time. This could be, if we look at appreciating asset, real estate should appreciate over time. It doesn't always happen. It doesn't always happen over shorter periods of time. In general, we are buying stocks and bonds because we believe that they will appreciate over time, unless you're shorting them, but then you're not really buying them. You're actually selling them first. In theory, if you buy crypto, it's because you think it will be worth more. These are typically the types of things we would consider appreciating assets. Now, in contrast, a depreciating asset is an asset that would be expected to decrease in value over time. So if we want to talk about depreciating assets, we would talk about cars. And I mean, I think vehicles more generally typically depreciate over time, although there can be things that happen in markets like we saw during COVID, where for a period of time, used cars were going up in value. But in general, cars, vehicles, they depreciate over time. Machinery, that the types of which you would use, in factories, etc. In general, furniture depreciates over time. Exceptions would be when a particular type of furniture becomes a collectible, but that's a very particular situation. So in general, you would expect furniture to depreciate over time. So if you want to buy a house and you have to take out a mortgage for it, if you can afford the payments, if the house is the right house for you, fits into the budget, in a vague sense, it's considered an acceptable asset to get a loan in order to obtain, because over time, the house should go up in value, your loan balance will go down, and you'll have made payments over the years. You will have something called equity in the house. On the other hand, if you buy a $50,000 car, finance it over 5 years, you end up paying $50,000 plus interest over that period of time. But at the end of it, the car might only be worth $20,000. You drive it off the lot. If it's a new car, you lose some value right away. So when you think about how much of my income should go into a house versus a car, and should I be obtaining a loan for a house versus a car, a critical difference is you expect the house to go up in value, and you expect the car to go down in value as it is older, as it has more miles. And you can do the math to sort of figure this out. There are all sorts of conventional wisdoms about how much you should put into housing from your monthly, but I'm not even going to delve into that right now. Those are controversial, sometimes fraught, sometimes completely toxic discussions. This is a more general discussion about types of assets. If you wanted to know the amount of money you would make from an asset over time, that's pretty easy to figure out. It's final value minus initial value. That's the change. And then you can divide by the initial value to know the percentage. So for example, if you are buying a house right now for $200,000 and you expect over time that it's going to be worth, $300,000, you're going to make $100,000. That's 50% of the original value. But if it's over, a 10-year period, that's roughly like making 5% per year. Now, I think it makes sense also to figure out the other costs associated. So on paper, you made $100,000, but throughout these 10 years, you paid real estate taxes, and you paid utilities and insurance. And if you have a mortgage, you paid mortgage interest. So to get the real return, I would want to subtract that stuff out, and you would find it's probably way less than 5% a year, except in really, really hot markets. What else is important to think about? Well, one thing is I mentioned periods of time when things can differ from what typically appreciates versus depreciates. During 2020, 2021, as I mentioned, various assets appreciated far more than historical trends. We saw this in both appreciating and depreciating assets. Vehicles were selling for crazy amounts. There was a housing explosion. Luxury watches went up. There was a period where crypto went bonkers, etc. So over shorter periods of time, you can see trends reverse in terms of what appreciates, depreciates, etc. But typically, we have a pretty good sense of what assets you would expect to be worth more 10 years from now versus worth less.